Silver has just gone through one of the strongest rallies in many years. In just a few months, it nearly tripled. Those who were positioned at the right time were able to do very real-life things. Pay off credit card debt, eliminate student loans, own a car with no remaining payments. And some even said they slept well for the first time in years because they finally felt secure about retirement. And then, something strange happened. Just when the trade looked its best, when the chart appeared textbook perfect, when the sense of victory began spreading through the community, some people started selling. Not panic selling, not running for the exits, but selling calmly, in portions, as if they were slowing down. That sounds wrong, because we are taught never to sell when a trend is still strong. And it is true, stepping away from a position that is winning big always feels uncomfortable. I remember very clearly staring at the chart, my chest tightening slightly, and asking myself, am I sabotaging something that is working extremely well? But that exact moment is when the real test begins. Not a test of belief, a test of discipline. And to understand why this decision is not impulsive at all, we need to be clear about what this analysis is actually about. This analysis is not trying to answer the familiar question everyone wants to hear. How much higher will silver go? It is also not attempting to predict the top, the bottom, or the perfect moment to exit. In fact, if you are looking for a specific dollar price at which to sell silver, you will not find it here. This piece is about something much harder. How to think when an investment thesis has already been proven partially right. It is about distinguishing between long-term conviction and short-term risk management. About understanding that a decision to sell does not necessarily reflect pessimism, but can reflect discipline and a shift in relative value. In short, this is not a price call. It is a framework call, a way of seeing. And it is precisely that framework that leads us to a gap very few people clearly articulate. If you have followed silver long enough, you will recognize a familiar pattern. Most discussions revolve around price measured in USD. Clean, round numbers appear repeatedly. 50, 100, 200. Charts are stretched. Headlines grow louder. And the conversation usually ends at a very simple point. Hold or sell? But there is another layer of the story that is rarely stated plainly. It is about how decisions are made when a trade is already winning, not when it has just begun, and not when everything is collapsing. It is precisely in the space between those two extremes that most mistakes occur. Many people assume that if you believe in silver, you must hold it at all costs. Selling is seen as a betrayal of the thesis. But in reality, markets do not operate on loyalty. They operate on relative valuation and capital rotation. An asset can still be rising in price while simultaneously becoming less attractive relative to another option. This is also where emotion is most likely to intrude. When unrealized gains exist only on a screen, the mind begins to whisper, "What if I just hold a little longer?" That question then repeats itself every time the price ticks higher. The irony is that very few people prepare for this phase. They prepare for the buy. They prepare for the downside scenario, but they do not prepare for being right. And that is exactly the gap this piece aims to fill. Not by giving advice to sell or hold, but by clarifying the mechanism behind the decision. Because once you understand the mechanism, you no longer have to react emotionally. To do that, we need to step back and look at the entire flow of the story from the moment this thesis was formed. To understand why today's decision is different from the decision a few months ago, we have to place everything back into its proper flow. Go back to the beginning. When silver was still around $33 per ounce, the atmosphere was completely different. There was no widespread excitement, no big headlines. The only thing that stood out was a number few people paid attention to. The gold-silver ratio was above 100. What did that mean? It meant that relative to gold, silver was extraordinarily undervalued. Over long-term history, that is not a normal state. And at that moment, the case for buying silver was not based on emotion or a compelling narrative, but on something very dry, relative value. The risk at that time was relatively low, while the potential reward was very large. It was a classic asymmetric bet. Then time passed. Prices rose gradually, 40, 50, 70, eventually close to 90. At the same time, the gold-silver ratio was no longer at an extreme. It compressed very quickly, moving toward the 50 range, a zone where history suggests things begin to look more balanced. And it is right there that the important question emerges. Not, how much higher can silver go? But, Do the conditions that made this trade attractive in the first place still exist?
This is the point many people miss. They look at the same chart, but through two different lenses. One side sees momentum, the other sees a thesis that has changed shape. And when the thesis changes, the rational action must change with it, not abruptly, but in an orderly way. That logic leads directly to the next step. Because if the same framework helped you buy correctly, it must also be strong enough to tell you when to reduce risk. The first analytical move sounds simple, but it is the root of the entire story. Why compare silver to gold rather than to the USD? Most investors are accustomed to viewing silver's price through the lens of the currency they use every day. That is entirely natural. But the problem is that if the very unit of measurement you are using steadily loses value over time, then all long-term comparisons become distorted. The USD is a fiat currency, and its purchasing power has been eroded over decades. When you ask, is silver expensive or cheap today compared to 20 years ago? You are implicitly assuming that today's USD and the USD of the past are directly comparable. In reality, they are not. Official inflation is only an estimate. It changes with methodology, with the basket of goods, with policy priorities. So, if you use the USD as a historical yardstick, you are using a ruler that stretches and contracts. That is why gold becomes a more reasonable reference point. Not because gold is perfect, but because it is a monetary asset that has existed for thousands of years, with supply that grows slowly and is difficult to manipulate. When you compare silver to gold, you are comparing two forms of commodity money, rather than comparing a finite asset to a unit that can be created in unlimited quantity. And when you do that, historical data begins to make sense. The second move lies in the gold-silver ratio itself. For most of modern history, this ratio has fluctuated in a range of roughly 60 to 80 when it sits within that range. The market is telling you that silver and gold are relatively fairly valued. There's no major distortion. But when the ratio surges above 100, as it has in the past, that is not a minor fluctuation. It is a signal that silver is being left behind in an extreme way. Not because silver has lost its intrinsic value, but because capital flows, sentiment, and market priorities have tilted sharply toward gold. It is precisely in that context that the case for buying silver becomes very clear. No compelling narrative is required. No grand forecast is needed. Just one simple question. If history carries any weight at all, which outcome is more likely, that silver remains permanently undervalued, or that the ratio returns toward balance? When the risk lies in the ratio staying where it is, and the reward lies in it compressing by dozens of points, you are looking at an asymmetric bet. And that is the kind of bet disciplined investors are always searching for. The third move appears when everything begins to work exactly as expected. Silver rises quickly, aggressively, and at the same time the gold-silver ratio starts to compress. This is the point many people miss. They see silver's price rising and assume the thesis is becoming stronger. But in reality, the very speed of the rise changes the risk structure. When the ratio compresses from above 100 toward near 50 in a short period of time, it means a very large portion of the adjustment has already occurred. The asymmetric part of the trade, where reward vastly outweighs risk, begins to shrink. Here, one thing needs to be emphasized. Shrinking asymmetry does not mean the trend has reversed. Silver can still continue to rise. But the probabilities and the profit structure have changed. You are entering a zone where volatility increases, and each additional move higher comes with greater risk. This is where many investors make mistakes, because they confuse being right about the trend with being right about the position. The fourth move is tied to an uncomfortable historical pattern. When the gold-silver ratio compresses too quickly, silver often overshoots. It moves beyond equilibrium in the short term, attracts attention, hot money, and big narratives. But after that phase, what often follows is that silver begins to underperform gold in the next leg. Not because silver collapses, but because gold becomes the more stable refuge as the market transitions into a new phase. If you have observed past cycles, you will see this pattern repeat. It is not precise to the day, but it is consistent enough to be impossible to ignore. And this is where discipline is truly tested. Because selling in this phase does not feel like victory. It does not resemble buying at the bottom when fear dominates. It feels more like leaving a party while the music is still good. You know you could stay longer, but you also know that risk is rising faster than reward. And a question begins to form in your mind: am I holding because of logic or because I do not want to miss out on more? The fifth move is how that decision is executed. Instead of selling everything, the strategy here is to sell in portions, specifically selling about 25% of the position. This number is not arbitrary. After silver has nearly tripled, selling 25% allows you to recover almost all of the original capital. The remaining portion, both psychologically and financially, becomes a free roll. You are no longer facing the risk of losing your initial capital. This reduces decision-making pressure going forward. And more importantly, it separates emotion from most of the remaining position.
Many people underestimate the value of this step. They think partial selling is hesitation. But in reality, it is a form of psychological risk management. When you are no longer worried about losing the money you put in, you can observe the market more clearly. You do not need to guess the top. You do not need to prove that you are right. You simply need to respond when conditions change. The key point to emphasize is this: none of the decisions here are based on a specific USD price. There is no sell at 100, no sell at 150. Everything revolves around relative relationships. If gold and silver both rise, but the gold-silver ratio does not compress further, then there is no logical reason to rush into selling the remaining portion. Conversely, if the ratio continues to compress aggressively, then further reducing the position is an act of discipline, not pessimism. When all of these analytical moves are put together, the picture becomes clear. The decision to sell part of the silver position is not a change in belief about precious metals. It is an acknowledgement that the trade has matured, and when a trade matures, the investor's task is no longer to maximize potential profit, but to optimize the relationship between profit and risk. In other words, discipline is not about how long you are right. Discipline is about recognizing when probabilities are no longer entirely on your side, and being willing to adjust before the market forces you to do so. And it is precisely at this point that the story begins to turn toward another perspective, one that many people do not expect. This is where many people completely misunderstand the action just described. They see the word sell and immediately assign a single meaning: pessimism. But in reality, if you place this decision in its proper context, you will see that it does not say that at all. It is not a statement about the future of silver. It is a statement about relative value at the present moment. What must be made clear is this: this is not liquidation. There is no pulling all capital out, sitting on the sidelines, and waiting for a major crash. What is happening is rotation. Rotating capital from where it has already risen significantly into areas with a more attractive risk-reward structure. Silver has not become bad. It is simply that, relative to gold and relative to its own very recent past, silver is no longer as cheap as it once was. Seen this way, the act of selling 25% of the position becomes something very different. It is no longer a bet that the market is about to reverse. It is an adjustment to keep the portfolio within a range you can control. You are not running away from risk, but you are also not blindly charging into it just because the trend still looks good. This is a subtle but extremely important distinction, because markets do not reward loyalty to assets, they reward loyalty to logic. And the logic here says that when an asset has completed most of the work it was expected to do, reducing exposure is not a betrayal of the thesis, but a respect for it. In other words, this action does not carry the message silver is about to turn bad. It carries the message conditions have changed. And when conditions change, disciplined investors do not cling to old behaviors simply to feel consistent. They allow themselves to change perspective, even when that change feels uncomfortable. To better understand this feeling, we need a simpler, more familiar image, a metaphor that helps anchor this logic in memory. Imagine you are driving on a wide, straight, open highway. You accelerate at the right time, merge smoothly, and for a long stretch everything is perfect. The car is fast, stable, with no obstacles ahead. This is exactly what a winning trade feels like. But then, once your speed is already high, the environment around you begins to change. The lane you are in is still fine, but more cars start appearing ahead. The margin for safety narrows. At this point, you have two choices. One is to stay in the same lane and keep accelerating simply because the road is still open. The other is to change lanes early, while there is still space, to reduce the risk of collision over the next few kilometers. Changing lanes does not mean you stop the car. You do not exit the highway. You simply choose a different lane, less crowded, less volatile, and more appropriate for your current speed. That is exactly what is happening in this decision. It is not an exit from the market, but an adjustment of position within the same system. This metaphor matters because it clarifies one thing: preventive action usually happens before danger becomes obvious. When people start slamming on the brakes, the opportunity to change lanes safely has already passed. Discipline is not reacting to an accident. Discipline is reading traffic density early and acting while there is still room. And this brings us to the next part. Because whether you change lanes or not, every decision must be tied to specific conditions, not blind belief. The most important point to clarify here is this: there is no certain scenario. Markets do not operate on promises, and certainly not on anyone's personal conviction. Every decision in this story is conditional, not predictive. If the gold-silver ratio continues to compress even faster, that typically leads to an environment where silver becomes increasingly volatile, not because silver loses intrinsic value, but because most of the valuation advantage has already been digested by the market. In that context, each additional move higher in silver tends to come with greater risk and diminishing marginal reward. At that point, holding the entire position is no longer a neutral choice. It becomes a choice with rising risk.
On the other hand, if the monetary system continues to be diluted, if liquidity remains abundant and finite assets continue to be favored, then silver still has reasons to rise. These two things are not contradictory. An asset can keep moving higher while holding it becomes less attractive from a risk-reward structure perspective. The real danger does not lie in choosing the wrong scenario. It lies in locking yourself into a single narrative. When you believe there is only one rational direction, you begin to ignore small but important signals. You start rationalizing every fluctuation instead of reassessing conditions. Markets rarely warn with a loud explosion. They usually change gradually, little by little, through ratios, correlations, and tempo. And the people who take the greatest risks are often not wrong. They are simply unwilling to adjust when the context has changed. That is why, instead of asking what will happen, the more useful question is, what signs indicate that the environment is shifting? And that is when we need to clearly define what should be monitored, rather than trying to predict the future. A more disciplined approach is to identify signals to observe. They do not command you to buy or sell. They simply help you recognize when the environment has changed enough to warrant attention. And in the current context, there are a few standout signals. The first signal is the speed of movement in the gold-silver ratio, not just its absolute level. A ratio can sit around 50 for a long time without causing any issues. But when it drops very quickly over a short period, that often signals enthusiasm building in silver. It is the speed of compression that raises risk, not a static number. The second signal is relative strength between gold and silver. When silver rises faster than gold in the early phase, that is normal in an adjustment cycle. But if you begin to see gold holding its pace better, with less volatility, while silver swings more aggressively, that is often a sign that capital is starting to seek stability again. It does not require immediate action, but it should be noted. The third signal lies in real yields and asset behavior. If real yields rise while precious metals remain resilient, that is a positive sign for the finite asset complex as a whole. But if you see silver reacting more negatively than gold under the same conditions, that speaks to a shift in the market's risk appetite. The fourth signal is the divergence between paper and physical markets. When paper instruments become highly volatile while physical demand remains stable or increases, that often reflects tension beneath the surface. This is not a short-term trading signal, but it is a structural signal well worth monitoring. Finally, there is capital rotation. No complex data is required. Simply observe where money is leaving and where it is going. When capital begins to prioritize stability over leverage, you will see that reflected clearly in the correlations between assets. The key point is this: signals do not tell you what to do. They simply help you avoid being caught off guard. And in long-term investing, avoiding surprises is sometimes more important than finding the perfect strike. All of this leads to a very practical question, not about the market,
but about you.
After all the analysis of ratios, capital flows, and risk structures, the most important question still does not lie on the chart.
It lies in how you react when things are going well.
Because losses are easy to recognize, but success can very easily make us complacent. Ask yourself honestly, if you are up 200% on a position, do you know how to reduce risk without sabotaging the remaining upside? Or will you be stuck between the two familiar extremes, either holding everything out of fear of missing out, or selling everything out of fear of losing what you already have? I say this plainly. This is the hardest part of investing, much harder than pressing the buy button when everyone else is still doubtful. Because at this stage, you are no longer fighting the market. You are fighting your own emotions, the desire to be right a little longer, to win a little more.
And it is precisely here that discipline reveals its true nature.
Not as the ability to predict, but as the ability to ask the right questions at the right time, even when those questions make you uncomfortable. So instead of asking, where will the price go?
Perhaps the more worthwhile question is this: if conditions change slowly in front of you, are you willing to change with them?
That answer will say a great deal about how you survive in this market.
If you find this analysis useful, consider subscribing to the channel.
Not to receive confident predictions, but to train together a more clear-headed way of looking at money, markets, and capital flows. Here, we do not chase the most exciting number of the day. We focus on the mechanisms behind price movements. In the next videos, we will go deeper into the relationship between gold and silver across monetary cycles, how to identify a melt-up phase while it is unfolding, and most importantly, how to rotate capital without falling into emotional traps. Markets always reward patience,
But they also punish stubbornness very harshly.
if you want to understand the difference more clearly, stay with the channel.